All right, so India's central bank just made a huge move by, well, doing nothing at all. Yep, they've slammed the pause button on interest rates. And in this explainer, we're going to break down exactly why this surprising inaction actually speaks volumes about the future of one of the world's fastest-growing economies.
So you have to ask, was hitting pause the right call, or was it a missed opportunity? To really figure that out, we need to understand what led up to this moment in the first place.
Okay, first up, let's talk about the big pause. We've got to understand what the RBI actually did, or, in this case, what they didn't do, and why it's such a big deal.
This right here is the number at the center of everything, 5.25%. The Reserve Bank of India decided to hold its main interest rate steady. Now, after a whole year of pretty aggressive cuts, this decision to just stand still, that's a major signal.
Look, this pause didn't just come out of nowhere. Starting way back last February, the RBI began this whole series of rate cuts to get the economy moving. In total, they slashed rates by 125 basis points. That's just economists speak for 1.25%. So after all that action to suddenly hit pause, that is a very, very deliberate change in strategy.
So why the big shift? Well, that brings us to the classic economic tug-of-war that, honestly, every central bank on the planet has to deal with. That delicate balancing act between pushing for growth and keeping rising prices in check. It's a constant dilemma, right? On one hand, you want to boost growth. You lower interest rates, it makes borrowing cheaper, and that gets people and businesses spending and expanding. But, on the other hand, if the economy gets too hot, you risk inflation just spiraling out of control. Finding that perfect sweet spot between the two, that is the toughest job for any central bank, and it's exactly where the RBI is right now.
So to really get why the RBI made this call, we need to look at the same data they're looking at. Let's dig into the numbers that are really driving this whole policy.
First off, here's the good news that's fueling the economy. The RBI is actually feeling more optimistic about growth. They've just upgraded their GDP forecast for the second quarter of fiscal year 27, bumping it up to a really strong 7.0%. That tells you the underlying economy is healthy and it's performing well.
But, and this is a big but, here's the other side of that coin. Inflation forecasts are also ticking up. The projections for the next couple of quarters have been nudged just a little bit higher. Now, it's not a huge jump, but it's definitely enough to signal, hey, let's be cautious, and that gives us a key reason for the pause.
And adding to that feeling of stability is this number, over $723 billion. That's the size of India's massive cushion of foreign exchange reserves. Think of it like a powerful shield against any big shocks from the global economy.
So, what do we have? Strong growth, some mild worries about inflation, and a big financial safety net. But there's actually a deeper, more technical reason for the RBI's whole wait-and-see approach. And it turns out it has a lot to do with the data itself. This brings up a really important question. I mean, if the short-term picture is pretty clear, why hasn't the RBI released its full-year forecast for the next fiscal year? What are they waiting for? The answer, believe it or not, comes down to one simple concept, the base year. Just think of it as the official starting line for measuring the economy. It's the benchmark that everything, all the economic growth, all the inflation, gets compared against.
And here is the crucial point. India's current economic data is based on the year 2011-12. I mean, just think about how much has changed since then. The way we all spend money is completely different now. Using that old data is kind of like trying to navigate a brand new city with a map from over a decade ago. It's just not going to work. To get a truly accurate picture, that map has to be updated.
And here's a quick look at what that update really means. The basket of goods they use to measure inflation is getting a total makeover. So the weight given to food, for instance, is probably going to go down, while the importance of things like housing and transport in our monthly budgets is going to go up, reflecting how we actually live and spend today.
And this is the date that everyone is watching. A completely new set of consumer price data is scheduled to come out on February 12th. The RBI is basically saying, hey, let's wait for the new, updated map before we decide which road to take. It's a really pragmatic, data-driven pause.
Which brings us to our final section, and really the big question this all leads to. What does this strategic pause actually mean for the future of India's economy?
At the end of the day, the RBI is walking a tightrope. They're trying to control inflation without stalling out some really impressive economic growth. So we'll leave you with the same question they're trying to solve. Is this pause the right move?
Can they successfully tame those rising prices while keeping that growth engine roaring? The answer is going to shape India's economic future. Thanks for tuning in.